importance of closing your books. How do I prepare my business for end of year reporting? And what happens if I don't close my books? The goal of any organization should be the ability to produce timely and accurate financial statements within a reasonable period of time. At any one point in time, management needs a financial statement, needs to know the results, where do they stand. We have to be able to provide it to them. The financial statements are very important to the management. They are critical in their ability to understand the financial health of the organization and allow management the opportunity to make decisions in a timely manner. Keep in mind that the goal is to create timely and accurate financial statements. Any procedure that can be incorporated into the daily operation will facilitate a quicker month closing process. So if you do it on a daily basis, it's better to get a quicker result. So to reach the point of financial reporting, many details must take place throughout and at the end of an accounting period. Generally speaking, closing entails the following major tasks. While this seems straightforward, this is an area that can cause work to back up and create a delay at months or year end. Ideally, activity should be recorded when it happens, incorporating as much of the work as possible into daily operations, rather than waiting until the end of the period. One of the easiest ways to locate missing or incorrect entries is to reconcile cash, since cash is part of most transactions. The first accounts that should be reconciled are the cash accounts. So organizations with numerous monthly transactions will benefit from also reconciling cash on a daily or a weekly basis. Don't wait for the last minute. This adds the benefit of knowing how much cash is on hand at all times. Once cash accounts are reconciled and any necessary adjusting or journal entries are made, the remaining balance sheet accounts can be reconciled. And finally, a review of the revenue and expense accounts is key to look for the accounts that are accurate, to look for if the accounts are reasonable in terms of balances. Check the expenses to see if they have been recorded in the correct accounts, the correct period, and that accruals and prepaids are accurately reflected. It's very important to go through all of these. Once the accounting team is satisfied that the general ledger is accurate, financial statements can be prepared and actuals can be compared to budgeted financial statements. As you may recall, the closing process requires adjusting entries to reduce the temporary accounts, revenue expenses, gains and losses, to zero balance by transferring these account balances to retained earnings. How is that important? If the temporary accounts are not reduced to zero, you will not be able to measure your revenue and expenses in the upcoming accounting period.